Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm joined with Phil Weiss. How you doing today, Phil?
I'm doing well, thanks. How are you?
Good. Well, glad to have you on the show, Phil. Why don't you tell the listeners a little bit about your background, and we can maybe start there.
Sure. I started my career as a CPA and a tax professional. I worked for Deloitte, ended up specializing in international corporate tax research and planning. Used to hear the stories about companies with money trapped overseas. I did planning and helped put it there because the tax rate system is very different. Decided I didn't want to do that kind of work anymore. I started writing for the Motley Fool when they had online portfolios, which I helped manage one of them. Went and got my CFA while I was doing that. I transitioned out of tax, was a writer for T. Rowe Price, finished my CFA, became an analyst. I worked for Argus Research, where I covered oil and gas stocks for 7 years. Left there and went to work for an RIA, and it's really the investment guy. And then from that, I launched my own firm about 5-6 years ago.
Nice. Congrats. So it's you obviously have a pretty storied background when it comes to numbers, investments, tax. I am curious if you have any interesting stories about the international tax stuff. To me, that just seems like, billionaires and bazillionaires hiding money overseas, but I'm sure there's more to it than that.
There is, and probably the most famous thing that I ever worked on was, if you remember, back in the late 80s, KKR did a leveraged buyout of RJR Nabisco.
Yep.
I worked on that transaction. I got sent there. I'd only been with Deloitte for a couple of years, and I got sent there by myself because the partner that I worked for the Forsman Little team beforehand. And they were told that anybody that worked for Teddy Forsman wasn't allowed to work on the deal after KKR won. So I got sent by myself. The book Barbarians at the Gate basically ended the day that I arrived in Atlanta. So when you read that book, I knew a lot about what it was talking about. And I spent 6 weeks there and after the deal closed, and then went back for another 6 weeks over the summer. In LBOs, there's a lot of debt. So we were trying to do the planning that helped them get the money out of some of the foreign jurisdictions tax efficiently if they could use to pay off some of that debt. That's kind of the most famous thing that I worked on.
That's awesome. I love that movie. I know that it was based on the book, but there was a great movie that I'm trying to remember. It was like back when I was younger, but I used to watch that movie over and over again. It was so brilliant.
It was. And the book, like I said, reading the book for me was special because I knew so much about what they talked about. And there was so much corporate opulence there too. Like their cubicles, not only were they large, they were made of mahogany. So when they had to sublet the building as they were moving out of Atlanta and sending it up to headquarters in New Jersey, they couldn't sublet the building because it was too expensive. They had to get different cubicles. They couldn't just add to make those smaller. It was just crazy. They'd have carts that would bring Nabisco and Planters and all the different brands and bring them out in the middle of the day, and you can take snaps, which we needed because we had some really great nights.
Well, and I didn't read the book, but the movie I'm sure took some poetic license. But I remember the guy who was running RJR at the time. That was the whole point. Like that's why he didn't get the deal, because of the opulence, right? And that and the fact there were some other things, but I think that was a big part of it, right?
Yes, it was a big part.
Wow. Well, I think times have changed and they've stayed the same at the same time.
That's about right.
Yeah, that's for sure. So that's pretty cool. So let me ask you before we kind of move on. I mean, when it comes to the international tax stuff, I know, my dad used to tell me back in the 80s when, organized crime was a thing, and there were a lot of books written about organized crime hiding money overseas and Swiss bank accounts. But, in the last, I don't know, 10, 20 years, a lot of that construct has changed. So what is kind of changed with that? Because people still have this vision of like, oh, use Swiss bank accounts to hide money, and it's things have changed. So maybe you can tell me a little bit about that.
So I work more on the corporate side, but the biggest change that I noted is when we did that work, we would have companies set up like these Irish financial centers and these Dutch holding companies because they had really low tax rates. And a lot of the other jurisdictions or countries had very high rates. And so we would funnel the money through the Dutch or the Irish companies to get them to the US at a low rate. Because the way it works is you apply certain expenses to your foreign income, and you can end up, even if the rate in the foreign country is lower, you still end up paying tax because of these residual impacts. But that's all changed. And now a lot of those foreign countries actually have lower rates in the US. At that time, the US tax rate was lower than everybody else's, or a lot of the countries. Now, when they lowered the US corporate rate, part of it was to combat that. So that's one of the things that's changed, is tax rates have changed a lot. And so that's what led to all that cash being trapped there, because then it became prohibitively expensive to bring it back.
Yeah, what do they call it? The Dutch Irish sandwich, I think is what they called it.
Yes, that's right.
And I think a lot of the tech companies were utilizing that that approach, so they didn't have to pay taxes. And I know there were two reverse mergers that happened like 5 years ago. I think one of them was Medtronic, or I can't remember. There were a few that were in the news.
Yeah, I think it was Medtronic. I think Allergan. Maybe I have that name wrong, but I think that was it. And it was not just for me, because I was from New Jersey. I know the tech companies were involved in that, but so were the pharmaceutical companies. That was really big for them.
So has that stopped? Did that, because I don't recall the changes, but has that stopped since, do you think?
And they had big manufacturing operations. I don't follow it the same way that I did when it was my everyday life, but I still think like that was really what helped Ireland a lot, putting that system in. Like, forget all the tax implications, but putting that low rate and getting all these companies to put manufacturing facilities in Ireland that provided so many jobs. So it was really good for them to do that. And so I think that they still have kind of those favorable rates, but currencies have changed since then, right? Back then, every country had its own currency. You had more distinct tax systems than you do now. So I think some of it's changed, but some of it's still the same, just because companies have pushed all that stuff offshore. And it gets expensive if you push the know-how and the knowledge that allows you to make that property, to make those goods overseas. And then you start moving it around across borders. There's a lot of implications to that. So it's not so easy to just undo it.
Yeah, it's interesting. Somebody was telling me that artists in Ireland don't pay any taxes, like musicians, and when I say artists, I mean people with it from the different arts, is whether it's I forget if it's royalties, but there's some part of the tax code which allow them to pay no taxes, I think, right?
I believe so.
So let me ask you this, because you spent some time there. How does that translate internationally? Because the politicians stand on their soapbox and they yell and scream, "Oh, these corporations are not paying enough taxes," but they don't really do anything about it. But I think globally, it's obviously a problem, right? Is that if you're going to overtax people, they will move their money overseas. So what can people do? Well, let me ask you this question. Let me ask it a different way. Should people go down this rabbit hole? Should individuals look internationally from a tax perspective to see if they can reduce taxes? Is it worth it?
It depends, because you have to understand there's a network of treaties, and the US taxes differently than a lot of the foreign countries. The US taxes you on your worldwide income. Some countries are only going to tax you on your income that relates to that specific country. So I'm not a big fan of doing that. There may be tons of it work, but the treaty network play a big role, because you don't want to get double taxation. And
Okay.
the other thing like that I did, the work I did was called transfer pricing at the end. And transfer pricing is, when you start to move these things around, you have to figure out how much value should be ascribed to the work done in each country. And the thing that I always felt was that if I've got a US company and it's got a subsidiary and subsidiaries doing different activities in a bunch of different countries, when they try to add it all up, if you looked at how much each tax authority is trying to attribute to that country, it adds up to more than 100. So you have to be really careful with that too.
Okay. Yeah, I think I heard that U.S. and one other country are the only countries that tax global income, and the other country is some. Let's just say it's more of a warlord type of country than a first world country. So those are the two that tax worldwide income. So it's kind of funny to me, but anyway, so all right, so let's kind of dive right in, because you have a really interesting background, and love the fact that you have so much history and detail with the international tax stuff, because there's so few that have that. But you also went and got a CFA, which is like getting like a doctorate in finance. So it's not a, it's kind of like a CPA. It's not a joke. It's a it's a really hard designation to get. But so why did you get the CFA? I mean, wouldn't imagine you needed it, but why did you go get it?
The real reason was it got to the point that I didn't want to do the tax work anymore. And when you do tax work, it's really hard to get out of the tax department. So that to me was my ticket out. I used to tell people that I got to a point where I felt like the purpose of my job was to tell companies how to shuffle paper around so that it would increase the size of their national debt. Because there are certain sales, like transactions that happen where title to property transfers makes a difference in how it's taxed. And so I can just change the documentation and now I've got a different tax benefit from it. And I just didn't really feel like what I was doing had redeeming value. And I had always had this investing bug. And I mentioned before that I was writing for the Motley Fool. And while I was doing that, one of the guys that I knew told me about the CFA. And I said, that's my ticket out of the tax department. So that's what I'm going to do.
Nice. That's awesome. So when you got the CFA, obviously you learned a lot from that. What were some of your takeaways from that? Like what, when it comes to investing, what would you say are your kind of biggest ahas from that, or the way that you would say this is how people should think about investing?
I guess some things that come to mind is, so I take a long-term perspective. I'm not an institution. And I think that in this world where holding periods for investment are getting shorter and shorter, one way that we have a chance to do something is to hold for the long term and not the short term. For example, in my own portfolio, I have stocks that I've owned for 25 years. So that's one thing. That I'm not a chartist. I don't believe in technical analysis. I studied it as part of the CFA program. Nothing that I studied about it convinced me that it was something that I wanted to do. And I remember when I was an analyst getting a phone call from a reporter and he asked me about some charts and I said, I'm sorry, I don't do that. I can't answer that. He answered me like, are you crazy? No, all you guys do that? I'm like, well, this one doesn't. I focus on the fundamental side because I find that that's where you can differentiate yourself. I was reading an article the other day about a guy that takes fundamental perspectives. And if you read a 10K or an annual report, you're ahead of probably 90% plus of those people that are investing because they don't read it. And there's a lot of hidden information that you can find by doing that. And one of my best calls is analyst came when I compared the accounting policy footnote for Chesapeake Energy, if you remember that company. And by doing that, it started to point out some accounting inconsistencies that made me put a sell on that company. Eventually I could be in a bankrupt.
Yeah, it's interesting what you're saying about, like the charting and fundamental. I feel like in the last 20 years, fundamental analysis went out the window. Like there was a period prior, well, actually, it's probably prior to 2000, because back then it was the same problem. But at least maybe in like early to mid 90s, maybe there was some value in fundamental analysis. But I feel like since then, it's been really hard to be a fundamental analyst and to be a value investor, frankly, because that has not been rewarded. And so this is, I like using both the charting and the fundamentals because I feel like if for the last 20 years, you're not rewarded for being a fundamental analyst. So, what's the point of doing all that work if you're not getting rewarded for it? Why not focus on areas that are rewarding you for it? And so I'm just curious on your take on that, because that's been a huge trend that it's been frustrating value investors for a long time.
It definitely has. And I feel that frustration at times. But I come back to the idea that if I'm over the long term, if I can identify really good companies that I can hold for a long time, like if you look at any company and look at its 52-week trading rate, it's usually pretty wide. And it's unlikely that the value of the company has fluctuated as much as that range would indicate. So I like to think that means that there's always opportunity. And so if I can find those good companies that I can hold for a long time, that's not what everybody else is doing. And I think that you can do really well taking that approach, and also looking for good companies when they're hit, when they're down. Just have to be careful because you never want to catch falling knives, right? That's the expression. You just don't want to do that, but you can find good opportunities if you're diligent. And there's just a lot of information in the 10K, or there's certain ratios and things like that I track for all my companies that I find are often very telling in terms of whether or not what I'm looking at is real.
So that brings in the question, right? Because you just raised a bunch of questions, a bunch of points, one of which was technical analysis. So you're saying you don't want to catch a falling knife. So when you're dealing with fundamental analysis, you have access to certain data through the 10Ks and what have you, and the footnotes, which is great. But if you're, information changes, right? For whatever reason, right? It changes, and that's not reflected in the 10K initially, right? Mm-hmm. Or maybe not for a while. So how do you square that? And then also with you'd mentioned catching a falling knife. I mean, basically for listeners who aren't familiar with that, it's basically when the stock starts falling, you don't want to just buy it on a dip necessarily because it could keep falling. So this is where the catch-22 comes in. If you're a fundamental analyst, you're buying it at a certain price because you think that's where it's accurately valued. But yet it could fall way through there and go much further. So how do you choose looking at the fundamentals, how do you decide when to buy a stock if it gets cheap enough?
There's a certain element that's just going to be your own gut and feel, right? But I want to have a sense that I don't want companies with too much debt, right? Like that concerns me. If I see too much debt on the company's books, that's going to scare me, especially when I look through and see what the interest rate is. There's some tools that I'll use to measure quality of earnings and the quality of the financial statements. If those tools flash warning signs to me, I'm going to stay away. But if those tools look good, then I'm not. So I'm going to try and look at things like that. I am going to try and value the company, but I know that there's a lot of guesswork that comes into that. So that's why the people that talk about margin of safety, which really refers to buying at a big enough discount relative to what you think the value is, matters, because then you have some room if you're wrong. You still have room. It's okay, but there's certainly an element of feel. Right? There's just no way, because we don't know, as you pointed out. Right? I get right now, companies are just starting to release first quarter earnings. If that's earnings season is going to go on for at least a month. The last time we heard from them was, in January. Most of them was in January, maybe mid-February, and a lot has changed. And so we don't always know everything that's going on. There's certainly an element of this that involves some guesswork and some forecasting and some predictions.
So how do you kind of look at it from that lens then? Because I feel like that is the most important thing. You could be great with numbers, but at the end of the day, there's so much guesswork in there that, how do you have people like Warren Buffett, who's historically successful, at being a fundamental analyst, and at the same point being successful with his investments. On the other hand, you have many other people who are just as smart, if not smarter than him, who are not able to make it. So how do you, for the listeners, because they're wondering this, like, how do you square that? Like, where do you come down on this?
I mean, this is why there's been such a movement to passive investing, which is investing in indexes, right? Because it's not easy. And for most of my clients that I work with, there is a pocket that gets individual stocks, because there's reason for that for them, whether it's if they want them or whether or not it can be more tax efficient sometimes if they have a taxable portfolio. But a lot of times it's just as easy to go with that index-based approach where you don't have to do that individual analysis. That's part of it. And if you look at the data, the Warren Buffetts are certainly the exception. They're not the rule. Most stock pickers don't beat the market.
But hasn't that been more of a recent thing? I feel like, so this is the curious thing about that trend. If you look back 40 years, there were still indexes, but people weren't indexing, right? And I think you could argue the fact that that indexes outperform most money managers, and I would say that's due to career risk, right? Because if they hit a home run, they get a little bit of a bonus, and if they miss and strike out, they get fired. So there's not a lot of incentive for them to do anything but hug the index. But the big question I have is with indexing that really started around 2008 because portfolio managers said, well, we missed it with good companies. Like I remember looking at deep value managers, and they had a whole portfolio of Countrywide and WAMU and all these companies that were fundamentally sound, but they went to zero for reasons that were beyond what they understood. So a lot of managers started to index because it was easier because they didn't have to take the risk. But now you've got this problem where you have basically 5 or whatever it is, 7 companies now that drive the performance of the index. I was looking at a chart the other day, and it showed that this year, even though the markets are up, they would be down except for 6 companies. 6 companies have buoyed the whole index, and those are basically the FANG stocks, more or less, which has been the case for like the last 10 years. So why not just invest in FANG stocks? I mean, I know it's silly, but that's basically the message that is being provided through the index is FANG stocks are the way to go. Otherwise, you own 494 companies that are useless.
It's a fair question. And I saw the same thing. I mean, I know like not quite one of the FANGs, but NVIDIA, that's just kind of like tied into that trend, right? Because they're a tech company, they're a chip company. They were up 90% in the first quarter. And if you didn't invest in NVIDIA, it's hard to beat anything. And if you had invested passively, you do have a stake in NVIDIA based upon its position in the S&P. And one thing that has changed, though, like if you go back in 2008, had a lot to do with this, is when they put in some of the rules. And if you go back 40 years, if I was looking at a company, there was not as much information as there is today. It's much harder to have an information advantage today than it used to be. The one thing I'll say against like the FANGs, I mean, I do have clients that own Apple, but Apple's also a company that's got a market cap that's a couple $1 trillion, give or take. How much bigger is Apple going to get? I mean, at some point, it can't keep growing, right? So you can't just have exposure to stocks like that because they can't keep growing forever.
Yeah, I mean that gets into the kind of the I don't know what you want to call it, the structural risks, right, of the system, right? It's like have you ever been to a multi-level marketing meeting where you go in and I've been to 1 or 2 in the past, and they're like, yeah, just imagine you could have 2 people and they would have 2 people, and they go on, and you're just like, yeah, but that would be like the whole world. Like, is the whole world going to be my downline? Like, no, that's just ridiculous. But it's like you're saying, it's the same thing with Apple. Like, you can't have a $100 trillion company when every other company is like $1 billion company. It just doesn't make sense.
Right.
But at the same point, I mean, that's how Ponzi schemes work, right? It's like, as long as you have people putting money in, they're going to keep putting money in. I don't know what Apple's PE is now, but I imagine it's probably still reasonably high. So what would you recommend given the situation we are now, right? Like right now, the markets are, I don't know, I would argue really overvalued still. How should people look at investing now? I mean, the markets came off 20-30% last year. This year they're up a little bit, but historically speaking, they're still really, really expensive. So how would you look at investing in this kind of markets?
It's tough because one part of my view is that when we start to invest, we're taking a long-term view that the market's going to go up. Because if you don't have that view, then there's no reason to invest. I also know that I've looked at the data that shows how you miss the market's 10 best days, whatever number of days you want to pick, but that's just the one that a lot of people use. Your performance really suffers. So if you're investing for the long term, then I just say, let's take a long-term approach. And I'm not going to worry as much about what happens in a given day, a given month, a given year, because I'm looking at longer term. And over the longer term, I've invested and I've made the implicit assumption that the market's going to move higher. So I do want to asset allocate so that I make sure that I and diversify my portfolio so that I'm exposed to different things, because not everything moves in the same way. So again, that's kind of why that index or passive approach oftentimes works for most investors are saving for the long haul. And if I get back to the planning side of the world, it's not really, to me, for my clients, about beating the market. It's about helping them live the quality of life that they want to do and accomplish the things that they want to accomplish. And if we sit down and try to beat the market, we expose ourselves to additional risk. And if you expose yourself to too much risk, well, if the market goes down, that means you're likely to go down even more. And I really don't want to have to call a client or have a conversation with a client about the things that they wanted to do that they can't because our performance was so bad. I'd rather say, here's what we need to do to accomplish what you want, and let's strive to do that.
Okay. So one thing I want to get to, in the interest of time, I want to make sure we get to this is you've spent a lot of time, certainly in the numbers, with your career and your background and your designations. But I did want to get into this topic of life planning, because you had mentioned that you tend to work with a lot of people in transitions, and you wanted your focus on life planning. So what does that mean to you? Like, when we talk about that area, and we can kind of go from there.
So life planning to me is to help you manage or take how the way that you spend your money. It should be in alignment with what matters most to you. And the life planning process, that's really what it's focused on, is helping you to determine, and working together to determine what's most important to you, because those are the things that we want to accomplish. So I'm currently going through training. I've been through the first two parts, and I have a 6-month mentorship. And at the end of it, I'll be a registered life planner. And the second element of the training is experiential. So I went through it and I did my own life plan. And the elements of my life plan, so I'm not doing, I just work with people in transition, but they're typically women in transition. And that ties back to things that I saw my mother go through in the difficult times that we had growing up with finances. And my mother passed away at an early age. And I view it that this is happening somewhat naturally, that I'm working with these women because I'm still trying to help my mom. And so my mother went back to school in her 40s. So one of the first elements of my life plan is I want to start a scholarship. It'll start small, but I want to be able to grow it over time to help women who decide to go back to school later in life, which is something that my mother did. And I knew that she did that so that she could improve her lot and be able to do what she wanted. Unfortunately, she didn't get there. But that's like one of the elements of my life plan. Things like that. That's really what it's about. I have a client that I'm working with who's trying to figure things out. She's been working her whole life, and now she's feeling really stressed. So she left work. So we're sitting here trying to figure out, does she have to go back to work? If she does go back to work, does it have to be what she's been doing historically? Can it be something different? And what else does she want to do? So we're in the process of working on her life plan. I mean, she's fortunate. Her husband had put away a lot of money. They can do what they want. She is in a position where she doesn't have to go back. So now let's figure out what it is that matters and how can she do that.
Nice. Yeah, that's so, for people who are kind of going through that sort of transition in their life, and, as listeners, if they don't know, they realize pretty quickly that your whole life is a transition, right? I mean, you go through different stages through different parts of your life, and you're constantly transitioning, and you're never the same person that you were yesterday, because you're always going through these evolutions and learning. And if you have kids, your kids force you into this. It's like, well, now I got to learn how to do this. I got to learn how to do that. Like, I got to learn patience. So, yeah. So I'm curious, what do you have a specific life transition that you focus on, or is it just kind of like transitions in general?
So it's typically, I said it's typically women, and they're at a point where they're just trying to figure out what's next. One common thing is, in the typical household model that we've had historically, it's changing some now, but in the typical model, the husband is taking care of the finances, and the wife is taking a primary role with the kids. Even if she's working, that's kind of division of responsibilities. And now the kids are getting older, they're in high school, college, empty nest is approaching, and trying to figure out what's next, what are we going to do? I don't know. And if she asks her husband, he just says, I've been saving, but I don't know what to do. All the rules change. There's a big change in the rules as you go from saving to spending. And that's a big part of it. And there's also the registered life planner designation is sponsored by the Kinder Institute. George Kinder it's considered one of the fathers of life planning. So there's specific questions that I ask to try to help you identify what your priorities are, what really matters.
Okay, cool. So as we kind of wrap it up here, any final thoughts you can leave us with, with the listeners that they can take away from this and apply to their own life?
If I go back to something I said, I think it's important to think about the idea that it's not about one of my clients actually said this to me. It's not about building the biggest pile of money. It's about figuring out what it is that you want to do with it and what matters to you and using it in that way. I think that's really the crux of what you're trying to do with, at least to me, with a financial plan.
I couldn't agree more. I think that is a great way to look at it, although it's hard to look at it in the moment.
Yes.
So where can people find more about you, Phil?
So the name of my firm is Apprise Wealth Management, and my website is apprisewealth.com. If you go to my website, you can schedule an introductory call with me. You can also sign up for my blog. I blog weekly. 1 week, I share 5 things that I read that I think are relevant. They're not all about finance. They can be about other things too. And then the alternate week, I blog on a topic that's finance related that I think is relevant. I just blogged about Social Security claiming mistakes. You can find content on my website about health savings accounts, Roth conversions, things like that. You can sign up for my blog and then you'll get it in your inbox every week. It comes out on Tuesday morning.
Great. Well, Phil, I really appreciate you joining us on the show, and thank you for sharing your wisdom with us.
And thanks for having me, Kirk. I appreciate the opportunity to speak with you, and it was fun to talk to you too.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Phil. Really appreciate him coming on the show and sharing his wisdom with us. As you know by now, Phil is also one of our panelists, so you get to hear him more often and a lot of his wisdom. So now we're into the panel portion of the show where we have our very own Doug Heagren. Hey, Doug.
Morning, Kirk. How are you doing today? Long time no see. I think we were talking just yesterday, and I think we'll be seeing you again here in a couple days. So, it's good to have these conversations, take a break from the day-to-day regime.
Absolutely. More cowbell. Yeah. So, all right. And we also have our very own Tim Baker. Hey, Tim.
Hey, Kirk.
Well, cool. So let's dive right in. So Doug, just, listen to the interview. We talked about a lot of stuff and we got down a lot of rabbit holes that we weren't intending to, but I think the listeners will really enjoy it. So, what were some of your takeaways from the interview?
Well, I think the big thing for me, I mean, taxes are always interesting, and always on everybody's mind, especially, we got, especially with the upcoming, debt ceiling discussions, and now 2026, we're going to have, potentially expiration of taxes. Taxes are on everybody's mind. It's the silent erosion of wealth. And, and some people would argue that it's theft, right? It's getting political. Interesting. It reminded me of especially at the beginning, talking about some of those international tax conversations. I know you brought up Medtronic. I live in Minnesota, so that was a big impact here when Medtronic decided to reduce their corporate tax liability and move their headquarters to become a foreign entity, which of course, being that they were one of the Fortune 500 companies in Minnesota, that was kind of a loss. But they also, when they moved to Ireland as their headquarters, it was interesting knowing a lot of employees of Medtronic that had highly appreciated stock that had to take an instant tax consequence of all of that, because the stock basically no longer existed, right? It was no longer domestic stock. It became a foreign stock. So while that was interesting for the bottom line of the company, it had a tremendous impact on employees that had been there for a long time and amassed a sizable amount of stock options and other and Medtronic in other ways. It also reminded me of probably one of the best. And again, depending on where you lean, you may think this is great or not. But NPR, and I don't know if they still have the show, but Frontline, if you're ever familiar with Frontline did a great episode years ago called Tax Me If You Can. Recommend anybody go out and watch it. It talked a lot about First, I think it was First Union, which became Wachovia, and a lot of the different types. They were really, and a lot of the sheltering strategies that they did, investing, buying trains and then selling the trains back to the company, doing things like, basically doing things that allowed people to be in situations where they would be able to write off a lot of taxes. It also talked about how the IRS came around later and basically said, and this is something for people to be aware of, if there's an absence of a specific rule on a tax strategy, the IRS has the power to come back later and decide that if it should have been a tax consequence. So there was a lot of tax strategies that were put in place back then that all of a sudden the IRS came around and said, you know what? I know we didn't have a rule on that, but we've decided that it should have been something that was taxed. So now we're coming back after you for that tax later, after they had been advised to do these strategies by, oftentimes one of the big six, which is now, obviously been consolidated to the big three. So I think the tax side of it was very interesting to me, especially with the foreign tax and a lot, just talking about some of the strategies that people used to utilize and are still trying to get creative. And you even talked about that, Kirk, how some of those tax strategies with Swiss banks accounts and things like that, not necessarily as prevalent today. I mean, the U.S. government and the Swiss government and companies have had some collaboration, although they're still the Grand Caymans, right? So that was one thing. And then obviously talking about index versus stock picking, which I will turn over to Tim there, because I think Tim has some good thoughts on that too.
Yeah, go ahead, Tim. What are some of your thoughts and takeaways?
Yeah, thanks, Doug. And by the way, Doug, thank you for bringing up Frontline. You reminded me I forgot to pick up tick medicine for my dog this morning. So yeah, I thought
it's tick. I've got a notice on my phone today that it's tick day for my for my dogs as well. So thanks for the reminder.
We're in the midst of tick season. So yeah, Kirk, what I liked about the interview, as Doug mentioned, was taxes are on everybody's mind. This is one of the things that we pound the table on with clients every single year. Our portfolios are exclusively exchange traded funds or ETFs. And there's a reason for that. It's we don't have a personal bias or, some, form of compensation. In fact, it's very difficult to get paid off of ETFs. And in fact, you can't, unlike a mutual fund, that'll include commissions and loads and all that kind of stuff. So we use them. One of the main reasons is they're extremely tax efficient. And so one of the things that you were talking about with Phil was, the picking of individual stocks, and picking individual stocks basically requires two decisions: when to buy, when to sell, or vice versa. And there's always going to be a tax consequence when you do that. So when you do that inside of an ETF, for example, if you use an index-based ETF that is using a rules-based approach like value or something like that. So every 6 months, the index is going to change so that it owns, the cheapest stocks in the S&P 500 or whatever, pick your index. It's going to own all the cheapest stocks in that index as a part of that value index that is then traded in an ETF. When the ETF gets rid of the old value stocks and brings in the new value stocks, there are no tax consequences for that. It's very complicated if you feel like we can get down that rabbit hole, but there just aren't. So if you're trading stocks on your own in an individual account, you're incurring those capital gains, assuming it's an outside of an IRA. But that's also happening if you have an active manager that's doing it inside of a mutual fund. So, that was a topic that was near and dear to my heart. Because the tax consequences of folks' investments, unfortunately, mutual funds are so popular and well known, and ETFs are less so. So people just kind of take these tax bills and go, well, I guess I got to pay it without being educated on where some of the alternatives are.
Yeah, it's funny. You guys brought up something that I was talking to an accountant today, and he had a situation with I don't know if you guys ever heard this, a sovereign nation. You could become your own sovereign nation,
Yeah.
which I've heard about for many, many years. And I don't know all the details because I didn't look into it that deeply, but it's basically you can decide to become a sovereign nation. So similar to like Indian reservations where you're cut off, you have your own laws, you have your own access, but you don't pay taxes is the reason that people want to do it, right? You don't have to pay taxes because you don't have to pay for fire and police and electricity and all these things. But yet, you won't have access to the US, so you'd have to be self-contained. So people say, "Oh, I don't have to pay taxes." I'm like, "Yeah, that sounds great in theory until the IRS picks you up and throws you in jail. And you can fight from jail if you want. Personally, I have a moral obligation to not get thrown in jail for my tax beliefs. Apparently, some people don't believe that. But
There's actually a Simpsons episode. Homer decides to become a sovereign nation. And then his power goes out and he doesn't know what to do.
there's a Simpson episode on everything. So
yeah, actually, you know what? I'm sorry, I got it wrong. It's Family Guy.
Family
Peter
Guy.
Griffin. Peter
Okay.
Griffin decides to become a sovereign nation.
That totally sounds like a Family Guy episode. That makes sense.
It does also sound like a Simpsons episode, though.
Right.
It seems like the Simpsons.
Well,
Simpsons did it.
sometimes Family Guy has a tendency to follow Simpsons, so let's not rule it out.
So yeah, so it definitely brings up a few questions. I mean, as we're kind of going down this road, we're talking about taxes. I mean, taxes are a really important aspect of of investing, right? And I know we were talking about before the show of the different aspects of investing versus tax consequences. So I'm curious, Tim. I want to get your thoughts because you have some pretty strong opinions there because you're an ETF guy. But how should people look at investing, whether it comes to individual stocks or ETFs or active versus passive? Like, how should people be thinking about the tax impact?
Yeah, so it like I say, it's there's a couple of pieces to, as you say, where my strong feelings come from. Number one, picking stocks is difficult. I know everybody, there's a lot of people out there that like to do it. There's a whole industry of active mutual funds that are predicated that you can pick stocks that'll beat the market. Let's not forget that Jack Bogle, may he rest in peace, started where are they now? $8-9 trillion company called Vanguard, based on the premise that these active mutual fund managers aren't beating the market. So why are you paying these fees? Just go buy the S&P 500. So picking stocks is difficult. If you've got a multi-billion-dollar industry on Wall Street that can't do it, what is it that tells somebody like me or an individual investor that they can pick stocks that'll do any better than the S&P 500? And by the way, all you had to do this year was pick, 7 stocks and you'd be crushing the market, and everything else would be getting hammered. The problem is everybody was getting out of all of those stocks late last year. As you know, the NASDAQ or tech stocks did negative 37% last year when the market was down 18. So anyway, I rest my case on that. In picking individual stocks that are going to do any better than the market is very difficult to do. But from a tax consequence, it's like I say, it's ETFs tend not to kick off capital gains. If there are more esoteric stocks that are in the index or in the portfolio that need to be sold as opposed to transferred in kind, and I know that's a complicated thing. We can explain that probably another day, but basically the reason an ETF, for your listeners, the reason an ETF doesn't pay capital gains is if they're tracking an index, they have a basket of stocks and they can trade that basket of stocks for shares of the ETF with an authorized participant like a Morgan Stanley or a Goldman Sachs, or vice versa. The authorized participant can deliver an ETF, or excuse me, a basket of stocks in exchange for the ETF. That's why they tend not to kick off capital gains. So from a tax efficiency perspective, that's way light years ahead of where mutual funds are. And in fact, I was just putting together a proposal for actually a client who's considering just hanging on to these mutual funds and showing him all of the capital gain distributions from all of the mutual funds that have happened over the last 5 years versus all of the ETFs that we hold in our portfolio. All of the ETFs in our portfolio are just dashes across the board. I think there's one line item where an international momentum ETF actually paid a capital gain. But so it's a really important consideration because especially if you're investing outside of an IRA, that tax cost has actually, as you guys know, Morningstar actually created something called the tax cost ratio. And they basically figured out a way to calculate if you have to pay taxes on all of these capital gains, how much does it reduce your return over a certain period of time? And ETFs, because they don't pay capital gains, have significantly lower tax consequences. The last thing I'll say, that's my soapbox on ETFs and taxes and performance and all that. Doug referenced the debt ceiling earlier. That is going to be a really big piece that comes out of it. They haven't really made a big deal out of it yet. But for those that haven't really gotten a lot of the detail, the proposal that was put forth by Biden and McCarthy over the weekend and is now being voted on, and the market doesn't seem to think much of it right now, but that is now being voted on. But a lot of those pieces are, well, okay, if we're going to suspend, by the way, they didn't raise, they're suspending the debt ceiling. If we're going to do this, then we need to have tighter caps on fiscal spending. And you're going to have a better balance between taxation and spending. And I bring all of that up because one of the most glaring things, and we put this in our weekly email last week. So the current debt ceiling is at 31.4 trillion. The estimated tax receipts of the US government this year is about 4.7 trillion. So think about that. If you think about, like, for a company like debt to EBITDA or your debt to cash flow, right? I mean, the tax revenue that comes into the United States it falls well short. It's a little less than a quarter of our national debt. So the tax thing is going to have to get figured out too. And you've seen proposals before from folks like our current president who have considered jacking up capital gains taxes pretty significantly. Excuse me. And that obviously would have less of an impact on an ETF investor versus an individual stock or mutual fund investor.
Yeah. So
that was a mouthful.
No, that's great. No, I appreciate it. What about you, Doug? What are some of your thoughts?
Well, yeah, like what you were just talking about with the debt. So the U.S., just according to debtclock.org, I mean, the U.S. tax revenue estimate $4.67 trillion in receipts. A U.S. national debt 31.8 trillion. So it's even worse than you set it up to be, right? That's what is that almost 1/6 of what we are paying debt on. So I mean, now obviously that's not the debt payments themselves, that's the total debt. But you're looking at $14,000 revenue per citizen against almost 100,000 debt per citizen. So, and 248. And by the way, this is an interesting point because people are always talking about who pays taxes, right? Debt per citizen, $95,000 debt per citizen. Take a guess, though, how much that debt breaks down to in debt per taxpayer.
No idea.
$250,000 per taxpayer. So even though, yes, $95,000 in debt per citizen, it tells you how many people are not calculated in actually having any obligation on paying any taxes. So it's $250,000 per individual that actually pays taxes in the United States. So that, what's that, put that almost two and a half times more per people that pay taxes. So I never caught that before. I thought that was really, really interesting. And yeah, I did see that one of the things they're talking about, Tim, and going to that fiscal prudence, is they're talking about, arguing that they're a requirement of a balanced budget coming out of this every year. And yet, what does that do? I mean, again, we're getting on a tangent now, but what does that do to the economic ramifications? Because people, one of the reasons the U.S. debt is this high is the amount of money that the federal government pays every year that feeds into our economy. How many people are employees of the federal government or make money from the federal government either directly or indirectly, right? And if they have to balance the budget, one of two things is going to happen. They're either going to have to come down significantly in the amount of money they're going to spend, or they're going to have to come up significantly in the amount of money that they're going to take in. And again, that comes down to either economic slowdown or increase in taxes, and more than likely a combination of both of them. So if you don't think, if you're not paying attention to this debt ceiling conversation they're having this year, they always say, people like to joke about, well, this time it's different. This time it's different. Like you said, they're not talking about raising the debt ceiling. They're talking about suspending it and then putting things in place that will force economic balance or fiscal balance, which again is not something that they have talked about and agreed on both sides in any of these conversations previously, because ultimately that requires both sides to concede in a lot of different areas. But it also has, if they do codify that, it creates an incredible amount of pressure both to raise revenue and to stop spending at the level they're spending. And that has, significant impact overall to the economy, not just locally, but globally. So I would suggest people pay a little bit closer attention to the conversations that are being had this year on that.
I'll actually make if you need another point, let me just address that. I do think that that is a negotiation tactic.
Sure.
I don't think either side is going to put a balanced budget amendment in there. It's not going to happen because it can't.
Yeah.
When's the last time it happened? During the Clinton administration, and that only happened because they took money from something else to make it look good, and it happened to be at the peak of the tech bubble. I mean, if you think about the dynamics, like that is, I don't want to say never going to happen again, but given our current financials, it can't happen. Yeah. So it's a nice talking point. It sounds good in the media. It sounds good on a stump, but it's never going to happen.
I agree, but I think there's somewhere in the middle where there's smoke, there's fire. There's things they're going to work on that impact into this. Now, and also one more thing I'll talk about the Clintons, the Clinton side of it. Don't forget that Clinton was president right after one of the biggest reasons that he became president, which was George Bush's infamous "read my lips, no new taxes," right? So when he agreed to pass the significant tax increases that happened at the beginning of the 90s, that helped fiscally create opportunities for the balanced budget that then came, the following, 4 to 8 years. So yeah, no, I agree with you. It's, none of that as they're talking is going to happen, completely. But I do think that, as Tim alluded, there are some things that are coming out of this that, are going to be worth paying attention to, because if they're going to suspend the debt ceiling, all right, if it's indefinite, well, then forget it. We won't even have debt ceiling conversations anymore. Problem solved, right? But
well, yeah,
well, they already
we
talked
wish.
about that.
Yeah, we'll deal with it in January. We'll deal with it in January 2025 when the debt ceiling never got raised, and we've raised another couple $1 trillion in debt between now and then. So now we're not 400 billion over our debt limit, our debt ceiling. We're a couple trillion over it.
Right. But then let's go into 2026 when the Tax Jobs and Reconciliation Act, or whatever it was called, is set to expire a lot of those tax cuts. So again, bringing this full circle, taxes matter, right? So I agree, so going back to what we were talking about there, I think that is one of the great arguments for where ETFs can be incredibly beneficial, because people do not put enough, and I see it all the time, oh, I don't worry about the taxes. Taxable accounts aren't as bad as, you think they are. They absolutely can be, depending on what you're holding. It's the number of people, especially mutual funds, that end up getting, those phantom taxes that come out at, from those embedded gains at the end of the year, and go, wow, I mean, I didn't realize how, you've probably had those conversations from people, at least in the past, where, they look and say, well, I don't understand. Why was my 1099 so high? What is all this tax I do? Well, that came from the mutual fund you were holding that, had been growing for, 3 to 5 years or whatever their schedule allowed them to do. And then boom, they eventually had to spit those capital gains out to you, and you get the benefit of paying it. It just cost you, 30% of the value of your mutual fund to pay that tax. That's a significant impact. The other thing I thought was interesting that you brought up is again, the part that a lot of people don't understand about how ETFs work with regards to your ability to, through an authorized participant, exchange, technically, once you get to enough shares of ETFs, I believe, is it 50,000 shares? I think is the limit. I thought 25 or 50 that you can then take, and you can actually turn in your ETFs if you want to, and actually get them to give you the basket of underlying stocks. So one of the things that you can also look at with the world of ETFs is, since, as you talked about, the visibility or the transparency of what most ETFs, and you and I talked a little bit about some of these new active to ETFs out there. So be careful when you're just buying an ETF, whether or not it falls into the traditional structure of an ETF, because you could end up having a difference there and having taxes you weren't aware of and other things that kind of go into that. But if we talk about a traditional index-based ETF, you can also look at the arbitrage that you're getting in those ETFs as compared to what those underlying stocks are. So if we keep it simple, let's say it's an ETF tracking an index of 60 stocks, right? And you're looking at that ETF and you're saying, hey, wait a second, this ETF is trading at $49 a share. And you look at the NAV or the net asset value of the underlying securities, maybe those securities are trading at $50 a share. Okay. Well, then based off of the, ETF being available at $49 a share, you are already at a $1 arbitrage profit on the purchase, right? Because you technically are buying that ETF cheaper than the cost of the actual shares that it is tracking. Now, on the opposite side, you could do from a selling standpoint. If the ETF is at $51 a share and the net asset value of those underlying securities are $50 a share, you have a $1 profit on that. So you've got someone in the middle called an authorized participant that sells the ETF and then, and then, or buys the ETF from the ETF, from the retail investor, and then they sell or buy the securities to match against that, in order to keep the ETF right around that net asset value. But there is going to be times where there is an arbitrage level there. Again, this is getting completely complex and understanding how ETFs really work. But again, hopefully, on Kirk, I know who listens to this. You've got, people worth $50, $100 million plus, right? That's who's listening. So they all have 50,000 shares of a single ETF in their account. But in the event that that does occur, or you're watching the value of that, that's one way you could potentially look at, and again, a value play on an ETF. Is it below what the value should be? Is it above what the value should be? Or does it make sense at some point to trade that ETF in for those underlying stocks? And there's, again, ETFs are such a complex and wonderful beast. We could spend plenty of time talking about just how they work. And I honestly, most people, even professionals, don't truly understand how they work. We've talked about, trailing stocks and people managing risks. Again, if you're listening, trailing stops are great for managing, can be great. Nothing's an absolute for managing risk on stocks. But because, again, you've got that authorized participant in the middle, because you've got a market maker that deals with the actual buying and selling of that ETF through the exchange, be very careful with trailing stops on ETFs, because the way that that works and when they make that purchase based on that order, you could have it go through the trailing stop and actually, in many cases, we've seen that happen through some of those flash crashes, sell out your ETF at the absolute bottom and miss a huge rebound. There's been a number of disasters that have occurred from people doing trailing stops on ETFs, not recommended by the ETF industry. So if you're doing that, a better way might be looking at limit orders, not stop limits. That's a conversation for a different day. Sorry, lots of stuff there. I'll turn it over. You guys can finish out because I think I've taken all my time today.
Yeah, no worries at all, Doug. I appreciate the insight. Tim, kind of final thoughts here as we wrap it up.
Yeah, I was actually just trying to find. I post a lot on social media about ETFs versus mutual funds, traditional financial advisor fees, that sort of thing. So I was trying to find. I think this is through March, but one of my social media posts was I just put the number 140 billion. And then underneath that, it was this is the swing so far this year out of mutual funds into ETFs. And that actually masks sort of a nit to all of that, which is index mutual funds are actually getting flows. It's all coming from active mutual funds. So when we talk about money leaving mutual funds, it's actually leaving active mutual funds, but it's still going to index mutual funds. And again, just the reason for that is the average cost of an active mutual fund, an institutional share class anyway, is 0.7%. You can buy the S&P 500 for 0.03%. Vanguard's VOO is 0.03%. They're significantly lower cost, as we've probably beaten to death. They are way more tax efficient. And for folks that like transparency, you can go on to Vanguard's website today, put in the little search bar VOO, and it'll bring up their ETF and show you all of the holdings in the portfolio as of yesterday. So very low cost, very transparent, very tax efficient. So I just wanted to kind of put that finer point on it, Kirk. We've been talking a lot about the tax benefits of ETFs. This is not some, conceptual, intangible conversation amongst a bunch of knuckleheads like us. This is real. This is happening. Trillions of dollars over the trailing years have left mutual funds and gone to ETFs. This is, large institutions, bigger, smarter financial advisors, but the industry is mostly still entrenched in mutual funds. If you look at a portfolio that's being managed by an advisor and it's still populated by mutual funds, I would for sure get some education on that.
Yeah, no, I totally agree. And Tim, appreciate you coming on the show. Doug, final thoughts from you?
Yeah, I want to tack one thing on to what Tim said, and I think this gets used a lot in a generic sense. When people think of the Vanguard statement of just go with index funds, and again, we've seen this over probably the last 20 years. It's probably in the heyday of the S&P 500. Most people, I mean, you look at FinTwit or you listen to people out there, just buy the S&P 500. Warren Buffett, who has come out and said, just buy the S&P 500. And that's because Warren Buffett does not think the average individual is as smart as him as a stock picker, let's be honest. And he's just saying, look, unemotionally buy it. But even Vanguard themselves has written numerous white papers about the value of active management, but it's in a different area. So again, I agree with what you're saying. The S&P 500, it's hard to, there's only 500 US stocks in it. It's hard to find the ones that are going to be the outlier and beat it consistently. And time has shown that active management is not going to beat the S&P 500. And I would argue that even on the international side of things, that active management is going to have a hard time beating most international funds because there's only so many global players in the international space that are typically going to what the international indexes are going to be or hold. But Vanguard has also come out in those white papers and said that is not the case when it comes to fixed income. Now, I know people buy fixed income in an ETF or an index. They recommend active management on fixed income because there's too many variables at play there. They've also recommended it for small caps or international small caps or small emerging because there's just so much more going on there than can be wrapped up into a small index. So keep in mind that as a general statement, indexing absolutely makes sense as a whole. But on the other side of things, there are areas where active management still wins when it comes to a better way of managing a certain asset classes. The other thing, again, this is totally off topic, but since I was staring at the ustechclock.org, this is interesting. I didn't realize that they had created a money creation section. I hadn't looked in it a while. U.S. Treasury dollars now, 838 million. Yeah, $838 million U.S. Treasury dollars. U.S. Treasury dollars in 2000 was 3 million. So it's gone from 3 billion in U.S. Treasury dollars in 2000 to only 838 million now. So that's gone down. M2 money supply, Kirk, we've talked a lot about that with 2000 or since COVID. Guess what the M2 money supply in 2000 was? $5 trillion. Guess what the M2 money supply is currently? 20 trillion. So we've gone a 5 times increase in the amount of money that's out there. And we wonder why inflation has gone up when the production of goods and services hasn't kept up with it. That's a massive increase in over the last 23 years. Last one, currency and credit derivatives went from 90 trillion in 2000 to 652 trillion today. Again, lots of money, lots of derivatives that's flowing around there. I just thought those were some fascinating numbers. But you know, that going into, again, one thing we've talked about a lot is inflation, taxes, money. It all works together in a crazy way. So
Great. Well, where can we find more about you, Doug?
You can find more about me at procollegeplanners.com. If you've got a child that's going to college someday, I don't care if they're 2 years old and you're just starting this journey of thinking, man, someday I might have to pay for college. How are we going to figure that out? You know, based on what we know college is today, or even more so, you've got someone that's entering high school. The clock is ticking. Time is getting shorter. You need to know today how to begin planning around that. Most planners don't spend a lot of time on college and housing. It's a critical component of most people's households. Get those numbers. We have a free report you can pull down, key numbers for college. Just go to our website, download the free checklist, procollegeplanners.com.
Great. Well, thanks for coming on, Doug. And Tim, where can people find more about you?
Yeah, metricfin.com, metricfin.com. And we've actually just done some clarification to our website after a marketing guru explained that our website was way too technical and embedded in factors and ETFs, and all of that information is still up there. But our 2 primary pages now are how we invest and how we plan. So basically our goal is to help investors invest and plan and significantly reduce costs and taxes. So all of our contact info is up on metricfin.com.
I'm looking at your I'm looking at your new site. It looks great. Everybody should go check it out.
Thanks, Doug. I appreciate it. Cost me $3,000.
It's well worth it, Tim.
Yeah.
Not everybody's as smart as you. So you gotta play to the 6th grade level, as they say in marketing. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.